Hi, and welcome back to the What's Going On in Banking podcast. I'm Ron Shevlin, Chief Research Officer at Cornerstone Advisors and author of the Fintechs Snark Tank blog on Forbes. You know, when we started this podcast, we did not want it to be a talk show kind of Johnny Carson podcast where people would come and go, hey, what's going on? Let's shoot the breeze. We really wanted it to make a podcast that responded to what's going on in banking and provide the so what. To date, we've really focused on a number of various regulatory things, news items, and I don't want to be so presumptuous as to think that we at Cornerstone are actually creating the news, but we did do a research study recently that I think warrants some focus on this podcast. Did a survey of consumers and actually had done a similar survey 3 years ago back when the pandemic had first hit in the middle of 2020. And we looked at who consumers were opening up their checking accounts with and found two things back in mid-2020. Number one, that the mega banks, the JP Morgan Chases, Bank of America, and Wells Fargo's of the world, and those are the three with Citibank, the mega banks, were kind of dominating the checking account opening activity at the time, but seeing a trend towards the digital banks and fintechs, who in the 3 years from 2017 to 2020 had really generated and captured a large share of the new accounts that were being opened. Over the past 3 years, I've had a lot of folks ask, hey, are you going to ever update that data? And so we finally did in the end of June of this year, and saw some really different things that wanted to share and focus on today. First off, digital banks and fintechs are absolutely dominating new checking account opening. The digital banks and fintechs, that we kind of lumped them all together, captured nearly half of all new checking accounts that have been opened up so far in 2023. That growth is coming predominantly at the expense of the large banks. The mega banks share between 2020 and 2023 has dropped from 24 to 17%, and the regional banks share has dropped from 27 to 21. So back in 2020, the big banks, both the regionals and the mega banks, were capturing about half of the market. Today, their share is down to 38%, while the digital banks and fintechs have increased from 36 to 47%. And having said that, and having seen a lot of the growth in new fintechs, neobanks, challenger banks, whatever you want to call them, the reality is that even that segment is being dominated by a relatively small handful of firms. Chime and PayPal account for more than 40% of the digital bank and fintech share. And if you throw in Square and SoFi, they're really dominating that space. I think it's also important to recognize and talk about why this is happening. And I want to get today's guest in. I know many of you will be familiar with Alex Johnson, the author of the Fintech Takes newsletter. I've known Alex for probably 15 years now, a former colleague of mine. Definitely one of the leading fintech theorists. I know you like to use that word theory, Alex.
Yeah.
And fintech influencers in the space. So, Alex, let me kind of get your take on things. Seeing these numbers, seeing these changes, couple of questions to tee you up. Number one, do you buy it? Do you believe that this is really happening? And if so, well, what do you think's going on here?
Yeah. Well, thanks for having me on. I do buy the data. I think that it is an accurate representation of the shift that's been happening. I mean, I think just for context, it is important to emphasize that this is new account openings. So it's not necessarily representative of overall market share or where all of the deposits in financial services are sitting. Obviously, mega banks are still in a very strong position there, as well as regional banks. But when we look at new account opening and growth, I do buy this data, particularly when I think one of the pieces of information you included in your article was that 72% of these new accounts that were opened were being opened by Gen Z or millennials. So it's younger consumers, somewhat logically, that are driving a lot of this growth, and a majority of that growth is going towards these digital banks. So I do buy it. I think the question about what's going on here is particularly interesting because when you contrast it with, maybe 5 years ago to 10 years ago, the discussion at that time when we were thinking about what are some of these new market entrants doing and how are they going to compete, the discussion there around new account opening was, well, they're providing a much more convenient account opening experience, right? Banks are making you come into the branch or, sign an ID card down in the branch, a signature card. They're making you jump through all of these hoops, or if they have an online application, it's kind of clunky and not very easy to deal with. And these new digital banks are providing a much more streamlined and convenient experience. And that's really what's the delta here and what's driving the growth for some of those early companies. Fast forward to today, I don't think we can really say that, right? I mean, excluding community banks and smaller credit unions that might still be a little bit behind the curve when it comes to digital account opening, I know for a fact, right, that in fact, all of the very large regional and super regional banks, and certainly all of the mega banks, they offer digital account opening. And the digital account opening processes you could probably quibble with a little bit, but they're comparable to the digital account opening experiences offered by these fintech companies and other digital banks. So it's not that that's driving the growth. And so I think that to me is the most interesting thing, is thinking about, well, what are the value propositions that are being presented by these digital banks that are substantially different enough that they're appealing to all of these consumers and driving this growth? And I know you kind of touched on that in your article, Ron, but like, what do you think of that as sort of a framing for how to think about the growth of these new providers?
Yeah, I'm with you 100% on this. It isn't going to make the digital account opening tech vendors very happy to hear this, because they really have positioned themselves as, being the generator of the growth. And I kind of agree. I wouldn't call it table stakes. I wouldn't call it parity, but I do think that there is something different. And I think it's the product that is different.
Yeah.
And, I think I should be a little more transparent here about the question that was asked in the survey and the answers. I asked consumers, first I asked them, when was the last time you opened a checking account?
Yep.
And then I asked them, when you last opened a checking account, who did you open it with? And I gave them choices like PayPal and Square and SoFi and all these providers. But it begs the question, is Square Cash App a checking account?
Yeah.
Is PayPal, do they really offer a checking account? I don't even know, But the important thing in my mind that I wanted to get across to a lot of bankers in particular is that you can argue with me all day long whether or not it's a checking account. It's not important. It's what the consumer perceives. We asked them a question. They gave us the answer. They think Square Cash App is a checking account. They think the PayPal account is a checking account because it is this blending of payment account and payment functionality with an account that stores money. The other thing, when you look at in particular a Square Cash App, is, well, you can invest, you can do P2P, you've got rewards, you've got tax prep, you've got all these things. I'm not even sure what you call it. And I think I got this from you. You had created a chart that I have since stolen. I'm sorry, I should really give you credit for this, and I'll start doing that. Yada was another one who kind of, aggregated these capabilities. So this is where I think the banks need to kind of take the lesson, is it's not simply, as you say, about digital account opening. It's about the fundamental product itself.
Yeah, I totally agree, right? I mean, I think that one of the things that fintech companies have done very smartly is to say, if we compete on the exact same ground from a product perspective as traditional banks, if we offer just a checking account, you can log in, you can check your balances, you can review recent transactions, you can deposit checks, you can do some kind of bill payment, and you can do direct deposit of your paycheck. Like, if that's the scope of what we're offering, then really there is no reason to go with us over a traditional bank. There's just no real advantage, especially now that the digital experience thing has gotten a little bit more equivalent. And so what fintech companies did, as you're saying, is blended together all of these different products that used to be distinct from each other into one sort of unified experience. And just to pick on a really easy example, I continue to find it sort of baffling how distinct banks treat, from a product perspective and the way they present their capabilities to customers, checking accounts and savings accounts, right? Because really, from a customer's perspective, what we're talking about is just two different pots of money that need to be adjusted periodically as I'm trying to save money or as I have expenses that come up where I need to dip into savings, but treating them as completely separate accounts where I have to go, I would like to make a transfer from this account to this account, and I know that it'll happen in this time, and it's like a very stately sort of slow process. That's not the way that I think younger consumers in particular want to think about it. They want to think about it as, this is all the money that's coming in. I have a set of goals, and I want to optimize towards those goals. And that optimization should cut across money that I have access to immediately, money that I'm trying to sort of squirrel away and not touch, money that I'm squirreling away and have a little bit more of a risk appetite to try to grow, which gets to your point about investments and, even companies like an Acorns where, they can round up your change and then invest that money in the stock market. All of those capabilities are being blended together into something that I don't really think we can call a checking account. And I'm with you. I mean, when I hear banks sort of complain about, oh, yeah, well, actually, technically, PayPal doesn't offer a checking account because it's actually this type of product under the surface. It doesn't matter, right? Like if you can do direct deposit and then within that account, it can accomplish all the goals that it needs to for the customer, it is functionally a bank account. And that's really what we're trying to measure is the shift in usage of these different accounts. And I guess that brings up the other thing I wanted to get your take on. You also asked about who's your primary checking account provider, right?
Yep, we asked that, and big shifts over the past 3 years. Back in 2020, about 12% of Gen Zers and millennials said that a digital banker, neobank, or fintech was their primary checking account provider. That percentage has pretty much tripled to about 36%. And I also found interesting is that even among Gen Xers and even among baby boomers, that percentage increased a bit as well.
I saw that.
In the Gen Xers, it went it was huge, from 8% to 28%, and among baby boomers, from 4% to 11%. So, God, even us old folks are getting into the act.
Well, and I'm curious, I mean, the question of like what makes something your primary checking account provider is so interesting, right? Because one of the things you pointed out in the piece is that a majority of the consumers that had opened these new accounts over the last couple of years, they had at least one other checking account, right? So this is something you've talked about a lot where consumers now sort of accessorize with multiple different accounts for different purposes. But I do think it's a really interesting shift over the last 3 years or so where, this is just my perception, fintech and digital banking was maybe sort of seen 3 years ago as like, oh, that's interesting. I saw this commercial for SoFi, or I saw that Chime, their logo was on the Dallas Mavericks basketball jersey. Like, oh, maybe I'll sort of open that account and see what it's about. There's a very big difference between that, which is like experimenting. I have probably 75 different fintech and digital bank accounts technically opened in my name. I have a lot of zombie accounts out there, but there's a difference between that experimentation, which is sort of casual, and the designation that, no, this is my primary checking account provider. And particularly for like Gen X and baby boomers, that's a shift that I would be super concerned about, right? If I was a traditional bank or credit union, because it's one thing to sort of flirt with and experiment with fintech. It's another thing to say, nope, that's my primary account provider, because that indicates a level of trust, that indicates I'm comfortable with these capabilities, that maybe indicates that, this set of capabilities that they're offering is now what I as a consumer consider to be sort of table stakes. Like this is what a bank account should do today. And I guess the thing I'm curious about, and maybe this was something you asked about or maybe not, but like, do you have a sense of how primary account status is tied to other things like where direct deposit is, or how much money is in an account, or which account is the primary transacting account? Is that something that you measure? Do you have a sense of that?
Yeah, we asked about that a while back. I actually didn't ask it in the most recent survey, but what I recall is that there was nothing very like definitive and that really stood out. It was either direct deposit was big, but to me, there's a causal issue there.
Right.
Something had to cause you to switch your direct deposit to that and then consider it. Often it was about tools and PFM type things that you use. Other people said just the level of engagement. So what's interesting, there was no one thing that kind of stood out. One thing I wanted to ask you about was, one thing that's very different is so far in 2023 that's very different from the prior years is the interest rate environment.
Yeah.
How much of this shift, and no, that you can't make it a quantitative thing, but is this shift towards the digital banks and fintechs being influenced by interest rates and are they buying new business with higher interest rates? And if the big banks and just even traditional banks raise their rates, would they win back the business?
Yeah. So I think my advice if I was talking to a bank or credit union executive would be do not think that just by raising your rates, you're going to be able to buy back these customers. I don't think that there's a huge connection, honestly, between this shift at a checking account level and rising interest rates. I think it has much more to do with the things we've been talking about in terms of product, utility. Another thing you touched on in your article is just brand and the amount of money that these fintech companies have been spending on marketing. That's obviously a big part of it as well. The interest rate thing is interesting because my perception, and I haven't studied all the terms of all of these different fintech products super closely, but for the most part, they don't tend to really compete on interest rate. Some of them have now opened savings accounts and kind of bolted those on, as I was talking about before, to their checking account. But even most of those savings products are not super high yield, right? Like, to use one example, Cash App recently added sort of a savings functionality. It's really geared around, we want to help you automate and bring discipline to savings. We want to make it really easy for money to just get set aside. As far as I know, they're not really offering much of an interest rate at all. They're certainly not offering like a 4 or 5% interest rate. And if you look at the core checking accounts that a lot of these providers are offering, they're also not really paying any interest at all. Chime doesn't really pay interest on deposits. That's not the game they're playing. So the growth of Chime, the growth of PayPal, the growth of Square, so the money that's being offered by banks or other providers who are trying to play that interest rate game, that seems very disconnected to the core growth among these younger consumers. And the other point just to make on that is that I don't think younger consumers, because they don't have a lot of money, and this is another thing you pointed out about the growth of these digital providers, it's mostly happening among less affluent consumers. I don't think they really chase rates because they don't really have a lot of money to make money on. So I think that's probably less of a factor maybe than banks and credit unions would hope for.
Yeah. Another question I want to get your thoughts on is kind of what's happening in purely the fintech space. Because one of the things that I think the data tells me, Alex, is that, yes, there's been huge growth on the fintech digital bank side. They're capturing a big percentage of it and seeing the growth on the primary stuff. But this is really concentrated in a relatively small handful of companies. Chime, PayPal, Square, SoFi, who really has done a great job of capturing the share recently, and then maybe throw in Varo and Current. After that, not a lot. And is this a bad sign for a lot of the neobanks, challenger banks that have emerged?
Yeah, I definitely think it is. I think that
the future.
The biggest providers always win, right? We saw this in banking, right? The big fish eat the small fish. That's just sort of the nature of the game. I think it's the same in fintech, honestly, right? There are a couple of neobanks, digital banks that have gotten to a scale and have a sort of brand presence. And again, SoFi has a stadium in Los Angeles with its logo on it. Chime does all kinds of marketing. Obviously, Square and Cash App have done a great job marketing and creating all these viral campaigns. There's a set of them that have reached sort of broad consumer awareness and consciousness. They can compete on a brand level with pretty much any bank in the US. All of the smaller neobanks that are trying to trail behind them, they have the same challenge, I think, that a de novo bank, traditional de novo bank starting up would have trying to compete with JP Morgan Chase, right? Like, you're just not operating at the same scale and with the same level of brand awareness. So I do think that is a potential challenge. I think the other thing I was kind of curious to get your take on is the big four that you kind of talked about are all kind of different from each other, right? Like Chime, PayPal, SoFi, Square, they kind of go after different segments, right? Like SoFi is really focused on sort of near affluent, mass affluent, sort of younger, but very sort of quickly kind of growing their wealth type customers, high student loans, obviously. Cash App and Chime are going after sort of lower income consumers and trying to provide sort of a full, almost super app experience for those consumers. And then PayPal, honestly, I was kind of surprised that PayPal was doing so well because I, from the outside, kind of perceived PayPal as being a bit of a mess in terms of different ambitions, and they have Venmo, but then they have their core PayPal stuff, and They're trying to sort of merge those together. So all of them seem kind of different from each other. They all have that brand ubiquity in common, but I don't know, did you find it strange that those were the top four? Were there any sort of differences or similarities that jumped out to you?
It wasn't surprising because the way that the consumers and the respondents answered the question was their perception of what checking account, was as a payment account. I want to agree with you about your general pessimism about the general challenger banks, but I still cling to the belief that there is an affinity strategy. And there's been some negative news in this space. Greenwood took out, or didn't take out, but acquired the assets of a forget what.
Kinley?
Kinley, thank you. Blanked out on that one. And of course, LG, the
Daylight. Yep,
Daylight
they went underneath.
Closed up shop. So, and then of course, just at the larger, the whole SVB was blamed on their concentration.
Right.
So there's a sort of a negative wave of, affinity strategy. I'm still not willing to concede to that because I look at, a firm like Panacea Financial focusing on young physicians, and they're doing well. Why? Because they have a great niche, and because they have lending products. They have a lending focus. It isn't simply a focus on interchange as a strategy, which has always concerned me about Chime. I still don't see them really diversifying the revenue stream there to the extent that I think they should, but what do I know? So I'm still not willing to kind of concede that the affinity, that the whole neobank thing is dead, but I think you're pointing to the focus on certain segments as being, and I still think there's opportunity for niches who can maintain it, even if the numbers aren't big, they can be profitable, but I think it takes more than the checking account / payment account to do that. That's I think the challenge is that unless you're PayPal or Square and you could have 50 to 100 million accounts handling payments, we have too many payment choices. So it's got to be something else that's your customers paying for that is going to attract them and keep them engaged.
Well, and that touches on another thing I was sort of curious about, which is, okay, all of these digital banks are acquiring younger consumers. That's a great start, right? You want to acquire the next generation, but what you really want is to grow with that next generation, retain them, grow your share of products with them. And I think that's a really interesting challenge, even for those big ones that we talked about, the Chimes and Squares and PayPals and SoFis of the world, because not all of them are in a great position to do that, right? Like SoFi, I think out of all of the ones that you mentioned after reading your article, they sort of popped out to me as the big winner, right? Because obviously they've grown their share tremendously. But the other thing about SoFi is they have a bank charter, right? And so when we think about, can they grow into a full service financial services provider for all these new young customers that they're bringing in, I think they can, right? They have a lot of those products today. I'm sure they have a aggressive roadmap of adding those. But as a full service bank with a charter, all of the deposits they're getting can go to fund all of the loans that they're giving, and they can continue to sort of build out that bank structure and make money like a traditional large-scale bank. Chime, by contrast, obviously they've done a great job on brand. They have a really compelling product. I think they know their market segment better than any bank knows any market segment. Like, they're really tuned into it. But growing beyond that is going to be challenging. We've heard for years that they're sort of right on the doorstep of getting into lending. They're experimenting with lending. Lending to their customer base is going to be really challenging, particularly in the environment that we're in right now. And they don't have a bank charter. Maybe that's in the plans to buy a bank or to apply for a de novo charter, but they don't have one right now. And so they have this really great base of young customers that are really big fans of Chime. Those customers are going to need credit cards and mortgages and auto loans and student refinance loans. They're going to need some of these other things. And I don't know if Chime will be able to get to a point where they can offer those to them profitably. So that's the big sort of unknown question, I think, facing them.
Totally agree. And Alex, we are out of time. So appreciate you coming on to What's Going On in Banking podcast. For everybody who's listening in, thank you for joining us. And I hope to see you in the next episode of the What's Going On in Banking podcast. Thanks a lot.